For the first time since around 2016, Kenya's central bank has cut its main policy rate. And that's despite, in the MPC's words, quote, the risk of perverse outcomes, end of quote. Now, today's cut was, in the larger scheme of things, relatively marginal, just about 50 basis points. But rate caps in the East African economy have cut off lending to the private sector since their introduction in September 2016. Annual private sector credit growth, 2.4% in December. It fell to 2.1% in February. And Zeta is a Kenyan economist who specializes in small and medium-sized enterprises. When we spoke a few hours ago, I asked her if the MPC's decision today will just make a bad situation much, much worse.
Intuitionally, it does not sound right. That logic doesn't really make sense. But I think the intent is good, but the way it's going to play out, I think, will be very different than what's expected.
Is this perhaps a signaling mechanism? Because I may be saying in the only context in which a rate cut makes sense is one in which you don't have rate caps.
That's right.
So in effect, they're probably saying that somewhere down the line, second half of the year, maybe sooner perhaps, we might not have these rate caps to deal with.
Well, I think that's precisely the problem, is that because there is a rate cap, I don't think they should fiddle with the CBR at all. I think they should leave it. And then when those caps are, or when they're removed, that's when you can start fiddling around with interest rates cap for monetary purposes. So if I had been part of that committee, I would have just said, just leave it the way it is, because I think the fundamentals of the economy are still the same. I don't think that there's any particularly optimistic thrust to the way the economy is evolving beyond the fact that we're not in an election year.
And of course, the reality is also informed by what Treasury usually says, because on one hand, they will repeatedly say year after year, we're going to aim to reduce the fiscal deficit by this amount of money, by this amount of cash every single year. We're going to try and reduce the amount of borrowing we have from the domestic market. But that never happens.
Yes, and I think this cut will push banks even closer to government, because now that it's become that much riskier to lend to the private sector, to individuals and companies, now even more money is going to be pushed into government, and therefore governments will crowd out private sector even further. Of
course, the one thing that could happen is to go back to what I believe was David Murari, who was finance minister at the time. This was 2002, 2003, thereabouts, where they basically drastically cut the amount of money that the government was borrowing from the market, and banks therefore had to turn around and say, okay, the only market we have here, realistically, is a private sector, so we have to lend to that. But given the amount of debt that Kenya has on her books at the moment, we've got Eurobonds that's due around 2024, and that's excluding the ones we issued a couple of weeks ago. That's really not going to happen anytime soon, is it?
You know, the fundamental problem that we're having, you know, in terms of fiscal policy going forward and in terms of the debt accrual, is that we're not seeing a change in pattern in terms of addressing the way we've been accruing debt for a long time. If you look at the budget policy statement that was released, I think, last month, you'll find that the trends that got us there will continue to go, unless we see a substantial modification in the budget policy statements or the estimates that are released later. So I think the fundamental issue that should be addressed is government spending. And a fundamental issue that should be addressed is government now crowding our private sector in the domestic market due to its debt appetite and due to the interest rate cap. And if we don't see that changing in terms of government's fiscal behavior, that problem will continue.
All right, let's wrap up with a look at inflation. 4.5-ish% in the month of February, levels we haven't seen in quite a while. Part of that, of course, due to base effect. Part of the expectation is that this will decline and essentially remain stable for the first half of the year. But towards the second half, energy inflation comes back into the picture, because we have a tax hike priced into that, specifically on petroleum products. How do you see that playing out?
I think you're right. I think that it will remain stable until those changes are made, and then we'll see a rise going forward. And I think that's why it's very interesting that they've used this opportunity to cut the interest rate because of inflation. We'll see if they'll reverse it if the inflation figures change.
But that whole argument about, you know, driving up energy inflation because we need to raise more money to close the fiscal deficit. Right. I mean, it is a bit of a circular argument from government.
I think so. I think government is being dishonest about its spending problem. And I think one of the other concerns that we're having is that if government is arguing, for example, that it wants to, you know, use a VAT 16% to increase revenues, we have a fundamental problem there, because they have a problem with accounting for the money that they already have. So it's not as though suddenly government will be more responsible in how it uses money because of the 16% VAT. The continuing problems will linger unless that's rectified in a very clear manner from the very top around fiscal responsibility.